Welcome, everybody. Grant Williams with me today. Delighted to have him. In fact, he's a co-founder of Real Vision. He's out there in the Caymans right now. We're delighted to catch up with him. Great macroeconomic views. Welcome, Grant. Delighted to have you on the channel.
Francis, thank you. I appreciate the invitation. It's nice to have a chance to chat.
Wow, there's so many things happening right now, and I like just general discussions. So I'm happy for you to take us in any of a number of directions. But we've got the gold breakout. We had silver technically start to move. That swung the gold-silver ratio down. We're a little bit getting excited about that. The softs moving. The Japan that you have very strong views in. You began your career there. Jump in, and of course, non-farm payrolls number coming tomorrow with all of this twitchiness on the real assets. I'm really interested in what's the most pertinent thing that you're spotting right now in terms of the macroeconomic game and the best investment trades.
Yeah, look, I think look, for everybody it's different. Everyone's got their focus in different things. But I think what you've just said is probably the most important thing to understand is that there is so much going on at the moment. There are so many things that are moving, and it's very easy for people to take their eye off the ball and be distracted by headlines here and headlines there. So I think it's a great time for people to really understand what it is they're genuinely interested in, the things that they're invested in or the things they're speculating in, and really try and focus and shut out as much of the noise around the headlines as they can, if it doesn't really affect the stuff that they're focused on. So I think that's a really important thing for people to understand, because look, we went from people being experts on cocoa to experts on the Ukraine war to experts on bridge reconstruction. I mean, everyone's an expert on everything, and you get drowned with all the people offering opinions and stuff, and it's really difficult to stay focused. The first thing you mentioned was gold. So let's start there, because it's something that I've followed for many, many years. And
Yes.
even though I've been a long-term holder of gold for, gosh, 20 plus years now, and I've never sold any gold. I just keep adding to it over the years. I think I've only made two specific calls over that time saying that now is the time that I think gold is going to actually have a really good run. One was in December 2015, and the other one was in last December, early January this year. And it felt to me like gold was going to have a break upwards, more because of the kind of buying that we saw, which was central bank buying for the last couple of years that we know is price insensitive. And so it's funny, I was talking with someone last night, a friend of mine, and we were talking about gold being at $2,300, and it's the quietest gold breakout that I can remember in that entire 20 years. It's kind of happening, and people are noting it, but there's no narrative around it. No one's talking about this is why gold is breaking out. And invariably, whenever gold pokes its head above the parapet, there's always a narrative. This time, no one seems to be able to construct a narrative, which seems unlikely in the world we live in today, because everything's based around narrative,
Yeah.
or gold is just confounding a lot of people. To me, it's a really interesting breakout, and I'm sure we're going to get some correction here. But once we put 2000 in as a floor, as opposed to a ceiling, it was a ceiling for a long, long time, and it's amazing how quickly 2000 has been left in the dust. So I think gold is something that a lot of people are starting to pay attention to, and a lot of people should pay attention to, because whether you're invested in it or not, it's telling you that something material has changed here.
I love that. But it also tells you possibly how few people maybe are engaged at the retail level, certainly, because they almost think it's not worth discussing. The retail investor need not worry their little head about that one near as much. And of course, as you said, we were resisted. Give us those dates for your calls again, because I was a bit late with the chart. You were around 2015, weren't you?
December 2015, and then again, I think early January this year was when I gave my speech
Yeah.
in Vancouver.
Great timing.
Um,
Great timing.
yeah,
Again,
I
because
got the timing right, but as I say, I don't. I'm a long-term bull of gold, so I'm always bullish on it. I mean, tactically, you sometimes think that the price is going to stop running and it maybe have a correction, which gold does all the time. But every now and again, you get these conditions that are just ripe for higher prices, and I think that's where we've been, and it just makes sense to me. Ever since I go back to the Treasury sanctions on the Russian central bank after the beginning of the Ukraine invasion, that to me, I wrote it at the time, and I've been talking about it since, was such a key moment where every central bank on the planet that holds dollar reserves, which is essentially every central bank on the planet, had no choice but to think of a plan B, to think of a way to mitigate the potential of them finding themselves on the wrong side of an argument to the Americans and having the same thing happen to them. And the obvious answer is gold. I mean, it's very, very simple. That's the obvious answer. And I think we're seeing that. And so if that's the move here, we'll talk about retail in a second, but if central banks have decided we need to hold more of our reserves in gold because it's a neutral reserve asset, it's no one's liability, no one has control over it, you've got the biggest, most price insensitive buyers in the world all looking to accumulate gold. And that's an incredibly positive thing. As far as retail goes, retail is always around this narrative. And I think the reason there hasn't been a narrative speaks to why we haven't seen retail get involved. And obviously at the same time, you've got strong narratives around cryptocurrencies. And so a lot of retailers kind of glommed onto those narratives. And it's which is great, for gold to be doing this without retail participation in the real sense. And we've seen, holdings of GLD, the holdings of the GLD ETF until this last week or so actually falling amidst this price rise, which is incredibly constructive for the price, I think. I think retail is still yet to come to gold, and if crypto stumbles, I think we'll pick up retail interest. And if gold continues to do this, it becomes something that people can make money out of. So I think there's a lot of structurally bullish things for gold right now.
Yes, there's nothing you said there that's even contestable for me. And the big players move the big markets first. That's why we almost call gold the God market ourselves of the precious metal. It must move first. And it's the insiders and the central banks for the reasons you absolutely gave. That we've lost an agnostic system. There's now political morality being projected and confiscation. That's probably the most destruction thing any ruling president allowed to happen under his watch, Biden, for the dollar. And the biggest gift to gold bugs, I think, is the Bidenomics of confiscation of other people's assets. And you nailed it with that one. And the other thing that I feel that is not being spoken about, because you talk about, it's not what's being said, because very little is being said apart from gold goes up. It's what's not being said. And we separate to gold, we highlighted the end of what we considered, and it's the first time I ever made this call on the bond market. That was in the late part of 2020, that actually is the end of the bond market. The events of March 2020, which will go unnamed, but we're all aware of, led to an absolute spill, a final capitulation in rates. There was a turning point for the debt market. And we instituted shorts on TLT, which is an ETF of long-term generally, but 20s and 30s. And that did exceedingly well. Then did a head and shoulders after, because we got in kind of at the head, almost at the top. And then it's further gone down. It's something technically I can bring up. But it seemed to coincide. And I tie gold to the debt markets, because we're talking about financial systems. We're talking about the death of one on one hand, in my opinion, through over-indebtedness, and the preeminence and return to the great truth that is the plane, while all the fiat currencies are the parachuting jumpers that are measuring their height relative to everyone else who's jumped. And I want to show you that, because at the point that the TLT or the rates on the US 10-year actually spilled to the 0.33 was during those events, March 2020, but it coincided at the same time with the gold-silver ratio having its highest point of flexion to the upside. And rather than seeing these things as coincidences, I see it as the natural relationship of competitiveness, substitution in terms of the system. Here we were March 2020 with that rate and that spill during those events. And we came out, I think the low was all the threes. And since then, this has actually been a bond rate bull market and a capital loss period. And I think someone was talking about those Austrian 100 years that they issued with negligible rates, the massive capital loss that has gone on in those, and I can't recall who that was. But if we split that screen, and this is why I love the chart so much, I'm going to stick on that gold-silver ratio. It was a blow off. What was a final capitulation low in the rate side was a blow off high in the relative valuation of gold, silver. And I'll just put those two on there. I'll take all the lines off. It's a bit busy. But isn't that fascinating? And it feels to me the end of debt, the suspicion and the loss of trust in debt markets. We were followed up with the UK pension crisis. You had banking issues. Banks are essentially intermediators of the debt. What's your take on, that case? Do you concur? And it feels to me that narrative of going back to the good old in your hand physical assets over the fiat construct with meet peak fiat and debt creation.
Well, I mean, we've kind of lived in this age of debt, and it's gone on for so long now that it's all most people know. And so the idea of sound money is alien to most people. They've never lived in a world. The purely fiat era began in August 1971. So there are very few people around trading today, or certainly the vast majority of people trading today have never been alive in a period of sound money. And so all this looks very, very alien. But if you take a step back and you look at a couple of hundred years of history, you'll find that the norm has been some kind of sound money that people could store their savings in and protect their purchasing power. So in a declining interest rate environment, you don't necessarily need that. People can borrow money, people can lever up, people can make the kind of returns that we've seen get made for almost accidentally for many, many years now. But there is always a price to pay, and we're seeing that start to happen now. Governments are being repudiated, and the idea of debt is being repudiated, and we've seen the level of debt build up to an extent that the servicing costs of that debt is becoming prohibitive. I spoke to Michael Howell recently, and he talked about the $350 trillion of debt outstanding in the world, and the fact that the central bank driven monetary system is no longer a monetary system, it's a refinancing system. And what has to happen is they have to somehow manage to refinance this year alone some 60 odd trillion of debt. And the only way to refinance that and roll it over is to keep rates as low as possible. This is why we're seeing inflation very sticky, and we're seeing the Federal Reserve and other central banks, desperately promising they're going to cut rates from 5 in the US to 4s elsewhere, as if that's an unsustainable cost of capital, which again, go back hundreds of years, the average is around 6%. If something doesn't work with a 5-6% cost of capital, you have to ask different questions. Not can we get rates down? Why is it unsustainable?
You don't have to go far back.
Yeah, look, you said inflection point, and I think that's the crucial thing to understand. We're at an inflection point, and part of that is an inflection in one of the words you used a short time ago, which is crucial, which is trust. Can you trust the banking system? Can you trust the government? Can you trust the Federal Reserve? Can you trust money? And this idea of trust in not just financial markets, but society itself is absolutely fundamental to how functioning civilized societies work. Without trust, it all falls apart. And that trust in cycles over time gets eroded and eroded and eroded. And you eventually find the point where trust breaks down. And wherever that be, whether it be in trust in politics, trust in governments, trust in money, trust in central banks, once it's gone, it's not that it can't be regained, but it's a process. And I think we're at the point now where that trust is starting to splinter. And I think it's ultimately going to go. And once that trust is lost, we are going to go into a period where all the things that you trusted, institutions, governments, the dollar, debt, all of those things, you don't trust them anymore. And realistically speaking, there are very few things that you can trust in. And gold, and I think this is a part of the reason it's running, is one of those. It's immutable. It's trustable because it's no one else's liability. You can stick it in a box. You don't need to trust it. It's going to be there. It's not going to lose its purchasing power over time. It's not going to decay. It's not going to disappear. You can trust it. And so I think I think society, certainly Western society, is heading back towards a period where people are looking for things they can trust, and there's no shortage of things that they can't, and a very small list of things they can.
Yeah, 100%. And it feels like we've also gone from that desperate search for yield on an asset, to rather, preservation of capital, rather return of capital than return on capital, if you can excuse the old cliche. It seems to come very back into fashion. I wanted to just show you three other charts and tell me what you conclude from them as well. Just interesting ones, because these were ETFs we singled out that are all on breakouts technically. So for us, this is a breakout with at least a 50% run on it to target. What are we looking at? We're looking at the Global X Coppers Miners ETF. So that is copper, because some people say, well, maybe it's gold. It's just a pet rock thing. The gold bugs are just driving it up right now, or it's just the central banks. There's no concern about to have on our money on everything else and debt. We'll extend. We've been doing this for many, many years. It's going to carry on for a lot longer. I've heard about the death of the system so many times, etc. It's never coming. It's another cry wolf almost in that sense in terms of debt. And then I bring you to the this chart, which is the oil and gas exploration chart, which is also starting to make headways. That, of course, is energy. And in terms of the role that plays in inflation, obviously you'll make your points around that, I'm sure. But we know that's a massive one. It's actually Exxon. Let me just show also coffees. We've shown cocoa before, but it might be worth getting it up just to give the soft some representation. But coffee is looking again like it's going to go up. This is the most expensive bean, which is the latest to move, by the way. So Robusta is ahead of it and is on a bigger run. So if I just throw a couple of those at you and mix, how does that, most of this you already well aware of and have been following, but doesn't that make the case that this is just the loss of value in money is perceived? And we're just not seeing it because it's globally synchronized. We're not getting the big currency moves outside of, say, the yen on the majors, which we can come to in a minute. But what's your take on those things? If we're accurate on the charts, all going up in and around 50, 60%, surely this is rate hikes, not cuts, or any cuts will be very small and very short lasting.
Yeah, I think that's most probably correct. The difference here, obviously, is we've got these two competing forces. We've got the forces that say rates are too high and need to go down, and we've got this kind of looming recession that everyone's, it's the Godot recession, right? Everyone's been waiting for it and it just won't arrive. Obviously it will arrive at some point, but this idea of no landing is starting to gain traction now, and that's obviously bullish commodities. But underneath the surface, you are seeing deterioration. You're seeing deterioration in credit spreads. You're seeing deterioration in defaults. You're seeing, if you look closely at the data, the jobs market is not as strong in the US as it perhaps seems, and we saw that in some of the payrolls numbers and the revisions. So I don't think it's a free and clear run with the industrial commodities. I just think you've got to be careful with those, because there is a very easily quantifiable case where you could get blindsided by some really poor data and the recession risks rise, and then people start to get very antsy, especially as they've run so far. So I don't think that's as straightforward a trade perhaps as it may look. I think over time, I happen to think that they all go higher, but they've had a run, and I'd be a little nervous about jumping in now, to be honest with you. You talked about oil and gas stocks, and I was talking to my great friend Gerard Minek last night, and he made a terrific point. Looking back at the tobacco stocks, and he showed me a chart going back to 1990 when governments did the greatest thing they could possibly do for the tobacco stocks, which was ban advertising and marketing spend from them. They took away their biggest expense, and on a total return basis since 1990, so including the technology bubble of the dot-com era, it's only in the last month or so on a total return basis that technology has nosed ahead of tobacco stocks. They've been tremendous things to own. And of course, we've seen this in oil and gas now. We've seen governments leaning towards stopping expansion of supply from oil and gas companies, which is always, as Gerard points out, their Achilles heel. When things are going well, they borrow money, they go out and they try and explore and they try and expand the supply. Well, it's becoming harder to do that. And so energy stocks And let's be agnostic about climate change here. Everyone can have their view. We're talking purely about an investment opportunity and what may go higher. Um, Regardless, energy stocks don't really care about my views on climate change or your views or anybody's view on climate
Yeah.
change. So let's just talk about the stocks. If the governments take away their biggest expense cost and the way that they always get themselves in trouble, um, and the conditions persist that you talk about
And
there,
add
here's a
barriers
very
to
good
entry, if I can
barriers to
jump in
entry.
and add,
Exactly right.
because you
Yeah,
can't get
absolutely right.
financing. You can't get financing
Exactly
anywhere.
right. Exactly right. So you can make a case that energy stocks are going to be terrific things to own. Nobody wanted to own tobacco stocks in the 1990s, and look down the nose at them ever since. But they've performed incredibly well. And energy
Yeah.
stocks, I suspect, and we're talking particularly carbon energy stocks here, um, are likely going to perform in a similar way. So it's, as you say, it's a fascinating time. There are so many cross currents, and it's difficult to stay focused and stay on track with what matters to you.
Let's pivot to Japan while you take a breather. And we both have an interest. Your career started there, and that's fascinating, and you'll have a great take. We were very lucky to have Professor Werner on as
Yep.
well, who gave us a great historical background, and we chatted with him. And it's been one that always stuck out for me because I always felt US and the sort of the Western timeline and also the European timeline, just think it's a little bit of something crazy out there, and it's unrelatable because it's wrong side of the planet. We don't always travel there as much. It's not easy to get to if you're in Europe or whatever. Yet it was the second at one point and probably third-ish biggest economy. And what so many people, just as my sketch, my quick take, and you can comment on that, was that actually Japan was ruthlessly effective when they were so good. It was all about the total quality management. And remember how hot they were. Then the lending
Yeah.
came in. You rode all of that. But they always were great businesses. But then they got so hyper over leveraged. They had this huge period of unwind. And there was a journalist, Marin Subinist West, that I used to read in the Money Week. And every year she said, this was the year that the Nikkei would turn because it was in the toilet. The blessed girl, she's smarter. She's truly smart. This is not a knock. I'm not having a jab, but she had about 15 years of calling it each year, only for it never to happen. And we recently said, this is it, the tailwind. It is turning on the Nikkei. The other beautiful thing about that is the yield curve control, which has turned the yen, instead of being something that was always appreciating throughout the 70s and 80s, the yen appreciated to the pound, yet Toyota, the likes of these auto manufacturers, Panasonic, actually continued to gain market share with a strengthening currency with a lot of core expense in their home market. We now have the situation where they now have the tailwind of the yield curve control because of their indebtedness. So the one gift of that debt bubble has now gifted them, in essence, a weakening currency. So the yen narrative is obviously strong. They can say as much as they like they want to raise rates. They can only go so far. There will always be an interest rate differential between what the US's rates are and Japan's generally, in my opinion. Tell us your take on Japan and how it is to now, and the great companies, and why the Nikkei might go higher in your view, or it's topped out, whatever your take is.
Well, first of all, Marin is terrific. All right, she's super smart, and for every year that she has thought Japan was going to turn, I've been right alongside her. So I'll handcuff myself to Marin and go down on that ship with her, no problem at all.
Yeah.
But Japan has been again, we've talked about these long time horizons and how people don't have long enough of a memory to understand what Japan was. And look, for 20 years plus, Japan was an investment wasteland unless you were domestically focused and in Japan itself. And a lot of people were playing the turn because of what Japan used to be. And the further away we got from what Japan used to be, the fewer and fewer people were interested in playing that turn because it was irrelevant to them. What was quietly happening during that period through necessity was Japan's corporate balance sheets were becoming much better. They were forced to delever, they were forced to get smart, and they were forced to build more sustainable, more robust business. And sales in Japan have been fine. We haven't seen problems with sales in Japanese companies, but all that time they've got their balance sheets in better shape. All that time, changes have been made to corporate governance, to the way shareholders are protected. And so very quietly, Japan has kind of built in the background this far more investor-friendly base of companies, as you say, many of which are world-class companies with tremendous businesses. And suddenly, Japan started attracting the attention of people like Warren Buffett 18 months ago, buying the Japanese trading companies, which are always phenomenal businesses, but they just fell out of favor and no one was really looking at them. And once you start to get a spotlight shining on Japan, people very quickly realize that you can find incredible companies um, at valuations you just won't find in somewhere like the United States, simply because of all the capital that's flowed to the US. And I think that's what's fueled this run in Japan that has seen it finally take out a 38-year-old bubble. Sorry, a 38-year-old high.
Yeah.
And there's a reason for that. Now, Japan has run, and as always, as is always the case, the people that start looking at it now are buying something that has had a good run. I still think there's further to go, um, but you draw the distinction between the Japanese stock market and the Japanese economy. The Japanese economy is definitely not out of the woods. Um, there are still challenges there to be faced by the Bank of Japan, the Ministry of Finance, and we will see how they go. Inflation, they've been trying to get it. It looks like they may be starting to get some traction, but they're a few bad prints away from that fading again. But I think now the spotlight is on Japan. People are starting to realize that there are companies here that we can buy on multiples that give us room to be wrong for a little while. That give us genuine expansion hopes. And again, world-class businesses in the kind of industries that you're gonna want to be involved in. So I'm bullish on the Japanese stock market. Have been for a while. I think again, like some of those commodities, it's had a run. It's a little stretched here, so it could very very well pull back. But it's not something that you should just buy the Japan ETF, right? And I've spoken about this recently in a number of places. The idea of having to do some work and singling out companies and finding businesses that you want to be an owner of as opposed to stocks you want to buy is a very crucial mindset to understand. Find some businesses that you want to actually own the future cash flows of, not this creeping idea that we've had over the last however many years of I want to buy that stock. It's a very different mindset. Buying a stock versus being an owner of a company is a very different mindset. And I think we're heading back to a period where you want to think like an owner of a company and not as a buyer of a stock.
Love that. I think that's a great point, and I feel it psychologically when I think one of the other. There's a more mature duration to the second than to the.
Exactly.
There's more speculative fervor to the first. And
Yeah.
yeah, I'll throw out a big number for you because you won't stick your neck out, and I don't blame you. 73,000 we see on this, and we have been calling for that since it was finishing this break. There's a massive multi-generational head and shoulders there that's turned. Whether it happens or not, it's a technical take, but I'll leave that with you. And I think you'll be looking at much greater valuation in a lot of great companies being acknowledged. And I want to highlight the Nikkei, something you will probably just back me up on, is that if the core costs, general costs, they will have plants outside of Japan plenty, but if a large part of core cost is in the depreciating yen area, and they actually are deriving income globally, they can actually gain market share and earn more heavier euros and dollars to their yen cost base. So they could actually become more profitable now with that tailwind of currency devaluation if it's expected to continue. And that's quite
that's an important thing, Francis. I think the yen. I think over time the yen appreciates, but it could go the other way in the short term. It's all going to depend on the Bank of Japan's policy. They've moved for the first time in 17 years to hike by just 10 basis points, and a lot of people think that the 10 basis points is 10 basis points. It's irrelevant. To me, the signal that's important is the fact that their mindset has now changed from you need to show us a reason for us to hike. Their mindset is now you need to show us a reason why we can't hike, and that's a very subtle change, but an important one. And I think if the Bank of Japan get the kind of data they need to support hikes, um, and people start to believe that Japanese rates could get to 1%. I mean, let's just think about that. 1%, it's nothing compared to the rest of the world. But what that does domestically in terms of attracting capital back home, what it does in terms of forcing people to think very seriously about the carry trade in yen, um, there are some potential tailwinds that could see the yen get much stronger in a very short space of time. It's not guaranteed by any chance, but it's gone from a zero possibility to whatever percent you want to put on it. Let's say it's only a 10% possibility. But if there's a 10% possibility of the carry trade unwinding,
I was
that's a
going to ask
significant
about
thing,
that.
and people need to think about that.
Yeah, so in your lots of Western investment being done with cheap yen converted into dollars, euros, etc. What is the interplay of a carry trade unwind? What do we see? Is that going to be the returning of yen from source borrowing to settle loans? That should see a buy or a strong bid in the yen, which will force more people that are carry trade borrowing because they're losing on the currency of their loan appreciating, so they unwind, and there's a sort of contagion effect. Is that the basis of your appreciation theory?
Well, yeah, that's a part of it for sure, and that's probably the part that could happen the quickest. Sorry, if that happens, if we start to see the carry trade unwind, if we start to see enough nervousness around this, enough belief that the Bank of Japan are intent on hiking to 1%, it's going to precipitate an awful lot of, at the very least, rethinking of this idea that the yen is a completely safe carry currency, and we can just roll it over as long as we want. And that will have a material difference. But for me, more importantly, with the Japanese being the biggest exporters of capital in the world, the idea that rates are moving positive back home, it's okay to own JGBs again for Japanese pension funds, Japanese investors. Again, a seismic change that we'll see not just the repatriation of yen, but to facilitate that, the selling of overseas assets. And Japan, as I said, the biggest owner of those in the world. So I can see why people expect the yen to weaken. I can see how that can happen too. But in the background, again, we keep coming back to this idea of, for the first time in X number of years, you've got another possibility on the table. And that, I think, is the crucial thing about the yen, is it's been pretty much one-way traffic, and you could be very confident that there were very few catalysts that would lead to a sharply stronger yen. Now you can't say that. You can't say, there's no possible danger. Now there's a very real danger. You need to handicap that as you see fit. You need to decide if there's a 5% chance that the Bank of Japan get anywhere close to 1%. But suddenly you've got more things to think about. And once you introduce more variables to long established trades like this, the smart people that have had them on will instantly begin looking at ways to mitigate those increased variables. And with the yen in the 150s, it's a fairly asymmetric play to assume it's going to stay here or go to 180 when the Bank of Japan is trying to hike, because the downside for the yen, and by that I mean a higher number, I think is far smaller than the upside in terms of the Japanese yen getting stronger. So it's becoming more and more of an asymmetric bet with every passing day, and I think people need to start understanding what that may mean for them if it goes that way.
Is part the argument not, though, they've got outside of the US with unfunded aspects taken into account in the first world, let's just talk, that one of the largest debt pools, and that they are almost got a very low limiter to how far they can go on rates before the payment is so high. So the market is almost calling the bluff. I mean, so what? You're going to go up by 0.1, as you were saying. Some people will go small beer. How much further can you really go before, just by definition, you're stepping on the self-destruct button? And we are going to price that in, that you might do a little bit, but it's all, beating of your chest and stamping your feet and rattling, saber rattling. But when you get called to fight, you're running for the hills. on the basis that you've just got no room to maneuver really. Where would you
Well,
yeah,
well,
go ahead.
well. Let's talk about that because it's a perfectly understandable argument. So let's go back all of 18 months and talk about the Fed starting a hiking cycle.
Yeah,
Everybody, myself included, was convinced there was no way they'd be able to get rates up above 3% without breaking things. No way. There is absolutely no
yeah.
chance. We got to 5 and change without, never mind
And have
breaking
you seen
things.
how
The
much they're
economy,
spending in the fiscal? Because I talk about this as the fire and
absolutely
water
right.
strategy. The monetary policy
Absolutely
gets
right.
tighter, but Yellen printed 7 trillion in last quarter alone, and it wasn't it wasn't the word we dare not say on YouTube, but the March 2020 events, she's equaled it. And that's surely keeping some heat to counteract the monetary policy. We've got a little bit of me talking big about my
Absolutely.
monetary policy and then actually hiding the right hand with the fiscal policy.
But what I would say is what we were talking about was not the rates going higher breaking the economy. We were talking about rates going higher breaking the debt markets, right?
Yeah,
And
yeah,
so no matter the fiscal stimulus you put on there, we've seen the deficit explode. We've seen the debt go up, what was it, $1 trillion in 100 days? The pace is
yeah.
accelerating, and those
Every
were
90
those were the
days, yeah,
concerns. The
yeah,
concerns were debt servicing costs, were the ability of companies to roll over. It wasn't necessarily the economy. Again, it comes back to this idea of refinancing.
yeah,
So, I think what you've said about the Bank of Japan is valid. But if everyone quotes this 250% of debt to GDP level in Japan, and again, in my conversation with Gerard yesterday, and we were talking once you net that off, once you net off assets versus the gross debt, the gross public debt, once you get all the way down to the net public debt, it's probably lower than the US. And
yes.
so
The US numbers
people don't
are right.
yeah, people don't bother going into it. They look at this 250% debt to GDP ratio on a gross basis, and that's a nice big scary number that satisfies an awful lot of narratives. And they don't then dig into this to understand the practicalities below that. And so, look, as much as we all sit here scratching our heads at what the Bank of Japan have done, um, the reality is what we're really scratching our heads about is not that they've done it, but they've kind of got away with it, right? They've managed to do this. Now their Ministry of Finance and their central bank, so the Fed and the Treasury, if you like, work much more closely together. And Gerard's point was this: if you think of Japan Inc. as a company, you look at their balance sheet, you've got these debts on the side of the Bank of Japan, but you've got the assets on the side of them off, and you put them together, and it's a much more feasible thing to do in a country like Japan. And suddenly, you could, all this stuff kind of goes away, and we can sit and argue whether it's right or wrong, whether they've gotten away with it or they haven't. But everyone has been sitting there for a long, long time now, thinking, why doesn't this matter? Why have the Bank of Japan being able to do this? Why have the markets not called them out? Why? Um, and ultimately that doesn't matter, right? The markets at some point may hold their feet to the fire, but the same thing could happen to the Fed and the Treasury in the US. We just don't know, and so things can go on a lot longer than you think. But can they go on forever? Probably not. And so, when I look at Japan, I can absolutely see the arguments why people think the yen, that chart you put on, there's a great example. Does it break out the top side of that range? Very possibly, very possibly. But there are, for the first time, and you look that going back in that chart, you can see we go back to 2021 there, the last bottom. So you've got almost 4 years of a pretty one-way trade. For the first time in those 4 years, you need to start thinking, well, the Bank of Japan is hiking now.
Yeah.
Is this a one-way trade anymore? And I would argue that it possibly isn't.
You're right, and the markets price things in. So the point I would say in support of you, because I'm kind of being devil's advocate and also
Yeah, sure.
supporting you, is that the market might have not priced in them being able to do anything, and even a small amount suddenly requires a lot of people to go and adjust models. And this rising wedge in a traditional technical analysis space, where you've just made marginally higher highs, 3 attempts not going higher, you typically get a fall first. So maybe too many people got a little bit priced into the short yen trade. We have a washout first. But I just think if that was to occur, eventually, and you relieve some of that excessive, maybe people that are shorting the yen or the carry trades, etc. Long run, just on interest rate parity, if the Japanese are always paying less on their debt, do we not validate the currency being the release valve for the pressure difference? If I'm a global macro and I'm in bonds, where do you go? For as long as the system survives, and then you add the exorbitant privilege of the dollar, the expansionary monetary system where everyone else owes interest back on it to the American. I hate all debt instruments as an investment, but I probably wouldn't be I would probably be forced to take a treasury with its yield over a BOJ, assuming all these other carry trades and other things are unwound. Let's say we get a bit of a sell-off and there's a normalization. Is that wrong, or is there other things I should be considering?
Well, look, isn't it beautiful? Who knows if it's right or wrong? It could be right, it could be
Yeah,
wrong. None of us know. This is
yeah,
the beauty of the game that we've all chosen to play. But the one
yeah,
thing I would say that people need to think about is the level of rates in Japan that it would take to start meaningful capital coming home. I'm talking pension fund capital, particularly, is a lot lower in Japan. It's not
then it is
5%,
new.
right? The Bank
Yeah,
of Japan the rates do not need to get to 5% to attract a lot of capital back to Japan. If rates got to 1%, if you look at what the pension money market fund equivalents are paying out this next year, I think it's
yeah,
75 basis points. In terms of matching liabilities with domestic instruments with no currency exposure, Japanese debt becomes very attractive to Japanese institutional pension fund type investors much, much quicker than people think, just in
yeah.
terms of that liability matching component. So I think talking about 5% in the US, 4% in Europe, 1% in Japan, no contest. It's just not as simple as that. And so
Yes.
these are
Yeah.
the times where people to the point that's kind of run through this conversation, this idea of long enough time frames that people forget,
Yeah.
people are making the wrong comparisons, I think, now due to a lack of understanding of Japan, because you haven't needed to understand Japan for 25, 30 years.
Yes, yeah, you just had to stay away. But also with the equity market potentially turning, they may even do, I mean, it's not as big a market as debt markets, but it's substantial. You could also see some return to domestic investment from pension funds that are offshore
Sure.
as well. So there's quite a few reasons why money could come back. Let's transition
Well,
to the
Francis,
car company.
there's one more important factor in this, which sounds kind of crazy, but it's a very real thing, and that is the kind of the way Japanese society is knit together. Now, if the Ministry of Finance went to the pension funds and said, "We need you to bring some money home," our next push is make Japan great again, for example, right?
Yeah.
And we
Add
need you to
that.
bring capital home. Yeah.
Yeah.
If that word goes out into the ears of the pension funds, believe me, they will bring capital
They'll
home.
act. Yeah.
It won't be, well, that's not in our best interest. We can get a 25 basis point better return over
More.
here. No,
Yeah. No.
that's not the
No,
way
they
it
will.
works in Japan.
Yeah.
And that is a very
In the
real
East,
thing for people to
anyway.
understand.
Yeah, yeah, they're very much more the community orientated. There's not the individualism is far less, and they will respond. And again, if they get a choice of equities or bonds, that you'd probably see both get a bid, and that would be quite fantastic. Let's talk about Tesla, because that's one that you've got a great view on, and we can use this to contrast maybe with the likes of Toyota. And I want to, for some of the people that are just watching this, and you're going to be the star in this conversation all the way, but Toyota have always sounded more sensible about EVs and have spoken a lot about hydrogen. Is it are they out teching Elon as well as being? I mean, it's ridiculous the amount of vehicles sold, the longevity of the company. We've often spoken about the perversion, or you have, let me rather say, and I've listened about the perversion of valuation with Tesla, and it's all the new thing. Now we're seeing a different narrative with batteries. We're seeing cars burning. We're seeing now that there's some reasonable proliferation in the UK, in America, in Spain, queues of 40 cars waiting and having to eat a pie in the rain for the better part of a couple of hours to get a charge. You can't do the distance. The battery's coming down. I mean, I'm even looking at the Porsche Taycan, the original ones. The price markets valuation on those have fallen so cheap. I'd almost have it as a golf cart just for fun. It's a beautiful car, but the problems are the batteries come out. They get better. They're already bringing out a new one. It came in very rich in terms of spec and finishing, and the dealers don't want to touch them. So they trust a good old diesel burner for a 4x4 or a petrol-based car. Is Elon going to get a turning of trend and a bit of a comeback? And is Toyota going to look like the smart guy in the room? What's your take on the future for those two?
Look, I think Toyota for half a century has been a world-class company in every way, right? And
100%
they've
agree.
faced some corporate challenges, whatever, but in terms of what they do, which is manufacturing and selling automobiles, it's a world-class company. And they've built up not only a phenomenal brand, but they sell so many cars, it's extraordinary. And people who have had Toyotas just go and buy another Toyota. That's just what they do, right? And they buy another Toyota without even thinking about it because they're incredibly reliable. And if you go back to the days back in the 70s when Japanese cars were kind of laughed at as being inferior, we've seen the same thing in Korea back in the 80s and 90s. Korean cars were a joke. And now you look at Hyundai's, Kias, they're extraordinarily well-made vehicles. And China is going to follow that path. And the difference this time is that China is following that path in a meaningful way in the EV market. And you mentioned the Porsche Taycan, the Xiaomi S7, which has been released recently, is an extraordinary looking car. I've not driven one, I've not seen one, they're not for sale, but we're talking, it looks almost identical. I'll leave my eyebrows as low as I can as the Taycan, to your point. Um, but it's $40,000, the top spec. And the Teslas of the world can't compete with that. They can't compete with it in terms of price. They can't compete with it in terms of technology. And Tesla has been
And if
priced.
they do, that technology can be stolen from the local manufacturing plant as well.
Yeah,
Because
I mean, there's a
good at that.
review. There's a review on YouTube somewhere. I don't have a link to it, of the Xiaomi S7, X7. I can't think, is it S or an X? And it's a 7 or 8 minute review, and it's truly extraordinary. This car. I mean, now it could all be smoke and mirrors, but I don't think it is. And even if it is smoke and mirrors, it's no more smoke and mirrors than a Tesla is. So you can compare smoke to smoke and mirrors to mirrors. Would you rather own an outdated Model 3 and pay 50 grand for it, or would you rather own this new, uh, incredibly technology heavy, sleek, sharp looking Xiaomi car for 40 grand? I think a lot of people are going to say, oh, my Tesla was great, but this is a better car for less money, and I don't owe Elon anything. When my Tesla's up for sale, I'm going to buy a Xiaomi, or I'm going to buy a PHEV, or I'm going to buy some sort of hybrid, whatever it may be, and that's a big problem for Tesla. It's a big problem for Tesla, one they haven't really had for a while, and we've started to see two things. We saw the terrible delivery results in Q1,
Yeah,
massively below expectations, and frankly, the stock should have been down at least 15% on that. It was down 5 and then rallied 1% the next day, so it still hasn't priced that in effectively. But we've also seen the average price of a used Tesla drop for 20 straight months.
yeah,
That's also telling you something. And
yeah,
so, my case for Tesla has always been it's an overvalued car company. It's not a tech company. Um,
yeah,
there are plenty of other aspects you can, if you want to dig into it, in terms of, the fraudulent nature of the numbers. There's so much in
yeah,
Tesla that if you want to dig into it, but let's take all that aside and let's talk about it as a car company. Are
yeah,
they going to sell more cars in years to come? I would suggest that the years of Tesla being a growth company are done. And if it's not a
yeah,
growth company anymore, it sure ain't priced correctly.
yeah.
And from where it is
Agreed.
now at 165 odd, it could
170
fall
today at
below
the
100.
moment.
Yeah, it's up a little bit. Yeah, but it could fall below 100 very, very quickly. very quickly. And there are people making very good cases to why it's worth no more than $14.
Yeah,
And at that price, it looks horrendous from 170 to 14, a 90% fall. But look at how it's valued at $14. It's not
yeah.
it's not valued at a stupid cheap level. It's valued like a car company, which is what it is. So look, I've been bearish on Tesla for a long time, but I've been long-term bearish on it. I haven't been shorting it and losing money as the stocks run, and I haven't been shorting it and making money when it's fallen. I believe over time the stock, frankly, goes to zero. I think the company goes bust. Um, but people get very energized about Tesla, and it's become kind of a hill for people to
Oh,
die on. And it says a lot about you and your thoughts and your care for the environment. It says a lot of things that don't matter to investors. It's a car company. It's not priced as
and don't
such.
stand
One
scrutiny
day it will be.
either. A lot of
It
things they
doesn't.
think it says doesn't stand under scrutiny either. You're actually not assisting. You're probably having a bunch of Africans scratch around in the dirt with terrible working conditions for cobalt. Just if I can
Right.
jump in a little, it's amazing what you were saying because I was recently in South Africa, and there's a swathe of incredibly sexy Chinese cars being driven around,
Incredible,
quite
right?
high
Yeah.
standard. In fact, there's one called a Beijing, in fact. So it's named after one of the cities. And you might think that's the last thing I'll be seen dead in, that particular model, but
Well,
it
hey, there's
looks
a Hyundai Santa
incredible.
Fe. I mean,
Yes,
same thing.
exactly. I was about to say we do all the same things. A California Ferrari and all of this. So it's quite reasonable that they would want a little bit of their geography and their culture to come out. And they were spanking cars. And a little side giggle is that if you have a Range Rover or the traditional or Ferrari or Porsche, you cop a bit of a South African receiver of revenue inquiry if you're a buyer. But these new brands are amazing cars. Some of them are quite expensive in rands, but they're really high end. And you avoid the receiver's investigative eyes because they're not yet clocked as luxury vehicles. So I thought that was quite
Right,
funny,
right, right.
just as a sidebar. But they look smacking. They look in great condition. They have a lot of great features, and they've got quite an interesting design. Some of them are quite sexy. Just to back you up. So yes, it seems like we both could be proponents for long run, a Toyota long, Tesla short, macro sort of delta neutral cars trade. Is that something you'd go so far as to stick your head on the block for, or would you say, nah, I'd prefer to choose my timing a little bit more?
Yeah, look, absolutely. Look, long run. Let's forget about stock price for 1 second,
Yeah,
right? Which sounds ridiculous given the nature of this conversation. But let's forget the stock price, and
yeah.
let's talk about being,
Investing in
going back
companies.
to this idea of owning a share in a company.
Yeah,
The
yeah.
long term, do you want to own a share of Toyota or do you want to own a share in Tesla? And I
Easy one
understand
for me.
completely, right, for me too, but I understand completely why people got completely wrapped up in this tech narrative and robo taxis and FSD and all this.
But the data, if you listen to
It's hard
Kathy
to
Wood,
find.
it's all about the Kathy Wood, the data collation and the cameras and they're
Right,
taking the
but
view.
but
But
let- but
won't
let's
other battery companies also have exactly that? And won't the Chinese maybe eventually not be
but
blocked
this is the
because they're
point,
spying?
Francis. This is the point, right? I mean, it's. I understand why people bought into that future dream, but there's no other word for it, I'm afraid. All this nonsense got stuck on the stock price. It didn't get stuck on the company, right? Because what's
Yeah,
actually happened is all the things that are promised, a million robo taxis on the road by, was it 4 or 5 years ago? Complete nonsense. It was nonsense at the time, but a lot of people bought into it because it's what they wanted to happen. So I
yeah,
understand it, but ultimately it's nonsense. And so, do I want to own a share in that business going forward? No,
mm,
I'd rather own a share in a business like Toyota, which I know is not only knows how to produce cars and sell them and service them and do all the things that a car company is supposed to do, but they're going to very quietly get on with their business. They're not going to be out in the news making all these
right,
wild claims. The stock is going to perform like a business. And if I evaluate the business and want to own it, I'm going to get that performance in the stock over the long run. That may be just me. I'm not someone that wants to dive into these technological pipe dreams and buy the hopes and assume that they're
yeah,
going to come true. A lot of people have made a lot of money owning Tesla stock. Let's be clear about that. If
yeah,
you've bought it and sold it well, You've made far more money than you have owning Toyota, but that's about the stock price again. That's not about the business. That's about trading the market and buying and selling the shares at the right points in time. It's nothing to
100%.
do with wanting
I love
ownership in
that
the business.
differentiation. Yeah, 100%. And it's like gold to some newfangling ICO crypto token with a whole bunch of hype.
Absolutely.
It literally is one with no history, one with great history, one that's proven reliability, and one that you're being sold a guy that sells you the biggest vision, and you're buying into some balloon juice vision that's got so many execution points of failure in it that you don't even know where to begin to start. I think we 100% agreeing with each other, and I love the way you eloquently put that. What else in the market would you put as a comment out there for people watching right now? How would you counsel somebody for this? I call it a hyper stagflationary time. We're going to have a lot of the stag. To me, it's a balloon that's being twisted. You know, the clown that makes toys for kids with the balloons. And we have two economies. We actually have the man in the street retail economy that is actually doing quite poorly, in my personal opinion. And then we have the sort of status magnificent seven that, you know, do the servers for the military industrial complex, get a lot of the kind of stuff at Janet Yellen is when she's writing fresh treasuries up 7 trillion to the good. We're going to tech companies, data, surveillance, finance, all the things that are a little bit dark and dystopian. That seems to be a different economy that's an absolute billionaire class, where the only world is up. How would you counsel people that are in the stale end of the balloon in terms of things of coping and positioning? And that can get into social as well as investment. If you
Yeah,
have a
that's it's a great question, and it's an important question. And I think a lot of people um, come to podcasts like this, to YouTube shows, all this stuff, looking for one thing, and that is what's been called an actionable idea, right? And I talked about this a lot because, to me, anyway, it's incredibly important. And this idea of actionable ideas, what people mean by that is a stock tip. They want to know which stocks are going up and how am I going to make some easy money? For me, everything is actionable. You know, everything you listen to is actionable. And for me, the worst action advice is a stock tip because it's a moment in time where you believe from starting point A, X is going to happen. And unless the show is live, anybody that listens to that advice is not starting from starting point A. Anything could have happened in the interim. The real actionable advice is how to think and why to think and not what to think. And I think people have been caught up in wanting to be told what to think and not how to think and why to think. And so for me, it starts with, if you want some actionable advice for people, I start here. Are you an investor or are you a speculator? Start with that question. Are you looking to invest precious, irreplaceable capital, or are you looking to speculate on prices going higher or lower? Because from that understanding, from understanding who and what you are when it comes to markets, from that comes two wildly different decision trees. And unless you're honest about what you're trying to achieve and who you are and what you are, and that wraps into that your tolerance for risk, you hamstring yourself and you handicap your chance of being successful from the first time you fire up your Bloomberg screen or your Yahoo Finance, whatever it may be. So understanding that is,
And
to
can I
me,
jump
the
in while
single
you
best
gather a
advice I can
thought?
give anyone. Jump in, jump in.
Yeah, if you don't know, you're being pushed the investor route, because if you go the other way, you're going to burn it all, and you're going to regret it, and you're going to be in the same place 5 years from now.
Yeah.
The slow dough is the good dough. The fast dough is the dangerous dough that washes in and washes out. Sorry, it's just, I love the way you describe
No,
that.
no, you're right. You're right. Everyone is looking for a get rich quick scheme, and very few people are looking for a get rich slow scheme. The outcome is the same, right? But everyone's in such a hurry. The get rich slow scheme gets replaced in time if you manage to be successful. Which, if you've been in markets, even passively, it happened. If you've been in markets for the last 10 years, you got rich. Face it, you got rich. Now you're in the stay rich scheme.
Yeah.
And that's very, very different, because staying rich is arguably
Preservation
the
element.
most important, right? Because making it is great, pissing it away is is just unforgivable. And so understand where we are in the cycle, understand that people accidentally got rich just by being involved. Don't confuse, as my great friend Rick Rule says, don't confuse brains with the bull market. Um,
Yeah.
Now think about, what are my goals from here? Because everything we've talked about, societal unrest, stagflation, inflation, deflation, confusion, everything we've talked about is suddenly not as one way as it used to be. And that should be telling you something. That's actionable. Everything is now a bit muddier. And so I shouldn't have the same degree of confidence in anything that I've had. And it's worked for me. But right here, right now, am I confident? No. If I'm not confident, what's my greatest risk? Losing my capital. So how do I maintain an appropriate risk profile to maybe participate if the market goes further, while at the same time making absolutely certain, and this is the crucial point, make absolutely certain I don't give it all back.
Yes. Money
That to
management.
me is the greatest tip I can give anyone. That should be your mindset.
Yeah. And I love something you said earlier in the interview that you've repeated a few times, and I'm certainly appealing to everyone listening to this. Is that a business I would want to participate in on a basis of longevity, history, track record? Are they marketing hype with over gregarious promises that go unmet, or are they stoic, conservative, detailed, almost to the point of, perfectionists? And in our contrast of Toyota and Tesla, that the one just pops. If the longevity is the Toyota every way up, and you should play the long game, not the short game. Even when you think you don't have time, you have more than you realize. And the real wealth is built in the duration, not of compounding in your favor. That everybody tends to get wrong. It's not in a quick hit where you quadruple your money in a week, because that's quickly given back. That was a great tip. Anything else parting shot wise before I ask you to tell everyone where to find you?
Yeah, again, I just want to reinforce the point that you and I both just made. If think about it this way: if Toyota was not a listed company, if Toyota was a privately owned company, and you happen to know the CEO and they were looking for capital, and he came to you and said, "Hey, we're looking for capital. If you've got 10 grand, you'd stick into the business." Um, you would think about that very, very differently than if someone said, "Hey, I think Toyota's a great buy here," because going into it as it's listed, you can click a button and be in, you can click a button and be out. If Toyota was a
Yeah,
privately held company, you wouldn't have the out. So you would think a lot more carefully about, do I put money into this company, because it's going to be in there and it's going to be
yeah,
trapped, and there will be exit points along the way, but I don't have access to liquidity 24 hours a day. And
yeah.
that is the mindset people need to be thinking. Would I put money in this thing if I couldn't get out? Um, and I think if you start thinking about things in a different way, and to be clear, the previous way has been appropriate for the times we've lived in. We don't live in those times anymore. And different
Yeah.
times require a different thought process. And the sooner people understand it and adjust accordingly, I think the better chance they're going to have of success.
Do you have a final one-liner comment, given that we're in inflationary on the stock market? I'm just thinking of all the people watching that and say it's a scandal not to have asked Grant. Let's talk the US, the S&P, or the NASDAQ. Given the stagflation and the inflationary side, and the devaluation perception of money, you see up, but then there's this real economy that is literally waiting for a demand-destroying event. So would you go volatile but generally up, or what would you be your throw outline
I,
for a quick
I,
take?
I think I think I think those markets are extended. Look, put it this way: I can see everything in place for a melt up. I can
Yeah,
see all the conditions are in place for a potential melt up. The question is, with the Nasdaq up 90+% in the last whatever short period of time, do I want to try and squeeze that extra juice out of that lemon and
yeah,
be wrong, and position myself for a melt up along with a lot of other people who are seeing the same conditions? Or do I want to be more circumspect and understand that the economic conditions, and we're now in a period where it used to be that the stock market was a reflection of economic strength or weakness. And
yeah,
now it's completely opposite, right? The economy is the stock market, particularly in America. And so we're watching expectations for rate cuts get pushed further and further out. We saw Jay Powell a couple of days ago finally come out and say the quiet part out loud. Um, whilst I can see the melt up potential, the risk reward for me personally, and I'm very different to everybody else listening to this, just isn't there. And I look at the declining breadth. The Magnificent Seven went, to the Super Six, the Fab Five, and now it's the famous Four or whatever it is now, right? They're slowly dropping by the wayside, and take those guys out, and things are not as rosy as they look. So for me, again, I can see why people would want to YOLO and think the market's going to go for a melt up. I get it. It's just not appropriate for me.
And it goes back to your investor or speculator, or are you trying to buy something from going A to B because you think it's a probability that will happen, or are you investing in a business? Excellent. Grant Williams, it's been absolutely amazing talking to you. How do people engage with your calm, level-headed, mature, for the long game insights?
You mean old? Very easy. Grant-Williams.com. Everything's on that website. And on Twitter, I'm at TTMYGH, which is the acronym for things that make you go,
TTMYGH. We'll put those.
You got it.
Yes, we'll put those in the edit below. Thank you so much for your time. It was really great fun, and I truly appreciate you. And I hope to meet you in person at an expo one day in the financial realm. Driving our brand new Toyotas, no doubt.
There you go. All right, mate. Thank you. Take care. Bye bye.
All the best. Bye bye.